Hello, everyone, and welcome back to another episode of the Financial Freedom Show. In today's episode, we're going to do an overview of some of the changes that have been done to my portfolio, as well as my newest holding, JEPI. So without further ado, let's get into today's video and explain some of the changes that have been done over the past week to my portfolio. I did sell out of VU, as was recommended by a couple of you in the comments. This wasn't just based on their recommendation. I've been thinking about this for quite a while. SCHD has outperformed VU over the past couple years recently. I feel like it's going to be an outperformer in the years to come as well, and that's why I've decided to make that the core of my portfolio. Going forward, I'm going to keep adding to this holding, and we're just going to see the dividend appreciation over time as this ETF continues to increase its dividend every year. We will see growth on that end. So that is one of the major changes that has happened over the past week, is my addition of more SCHD, and that's going to become about 80% of my portfolio as my target. And then the other 20% is going to be in JEPI. Right now it's 50-50, but that's going to change as I continue to add to SCHD. JEPI is a covered call ETF. We will go into that later on in the video. But basically I sold my entire position in Stag Industrial and put it into JEPI. It currently pays a 10% dividend rate, so that will be very nice. It's a monthly dividend. And as you can see, so far, let's go year to date, this portfolio is only down 3%. That is because I sold relatively near the top and just continued to add as the market went down. I'm going to stop trading in and out of the market. I'm just going to leave this portfolio go as time goes on, and we're just going to see how it performs. I think it's pretty interesting to use this portfolio's performance against maybe other YouTubers like Joseph Carlson, just to see how it performs in comparison to them. They're always stock picking and trading in and out of different positions. I just want to see what a portfolio would be like if it was just in ETFs and covered call ETFs. The majority of my portfolio, though, is going to be in SCHD. That's just going to be the way it is. It's not going to be like many other YouTubers where they're just chasing the newest type stock or going into different positions as they see them outperforming. I'm just going to basically be lazy and put everything into an ETF and just let it go to see how it performs. So you guys can track that with me. That's going to be pretty interesting to see how it goes over the next few years. I plan on making videos as long as possible just to hopefully someday get to $1 million in this portfolio. I'm going to be adding to it as I get paid, as I said before. You'll see that every other week as the portfolio continues to grow, and hopefully it outperforms the S&P 500. It won't be guaranteed. Right now my portfolio has a relatively high dividend payout rate. So far this month, though, we're up 10%, so that's pretty nice. This past week, we're up 5%, and the past day, we're down 0.21%. Over the quarter, we're up 32%, which is insane. These are, though, money-weighted returns, so basically it's not the actual percent. It's the number on the left there. That's the actual gain. So we've gained, so far this year, we've lost about $657. But in a year, we've gained 1,700 overall. Like if we go to all time, we've gained $1,700 in this portfolio. That is with $1,000 of market gain and $690 of dividend income. That is pretty good for the relative weakness of the market recently. Hopefully that continues to improve over time. But I can't predict the future, so I'm just going to keep adding to these positions and let it go and see what happens. It'll be fun to see how no effort put into choosing stocks or chasing the latest trends will perform compared to some of the other YouTubers out there. So I look forward to seeing what happens there. Without further ado, let's get into checking out JEPI. Basically, this is a covered call ETF. So what they do is they buy underlying stocks and then sell covered calls to the market. And then they provide the income as a dividend back to the shareholder. So with this current dividend payout rate is about 10%. That's going to be pretty nice for income so that I can add to other positions. I'm looking to take all of my money that I get in dividends from JEPI and put it into SCHD. That way I can get a growing dividend over time. I wouldn't recommend JEPI to people who are early in their investment journey. It's more of an income ETF. So basically it's there to provide retirement income if you have a lot of capital with a relatively stable performance. So far this year, JEPI is actually outperforming the S&P 500 with both its dividends reinvested. Even without the dividends reinvested, JEPI is currently outperforming the S&P 500 this year, which is really nice for those who are looking to retire. You can add a bunch of capital into this ETF, and it will provide relatively stable dividend income. It does fluctuate over time, so the dividend goes up and down based on how much money they make from their covered calls each month. But as the market goes down, this portfolio tends to outperform relatively well. The only drawback is when the S&P 500 goes up, this tends to lag and go up slower. That is also made up for by the 10% dividend rate. So in an extreme bull market, this ETF might lag. So that might be why you want to include it only in a retirement scenario. But basically, I'm adding it so that I can have income now as opposed to having income in the future. The main thing with SCHD is dividend growth. So over time, your position will continue to get higher and higher dividend payout rate. That'll be the payoff in the future for investing in SCHD. With JEPI, it doesn't really improve over time. It just stays flat. So the payout rate is going to be relatively the same from now until whenever you retire. So you don't want to keep it for the long term if you're just starting now. I would say if you want a high dividend payout rate for the current market downturn, this would be a good option. But unlike other YouTubers, I'm not going to give you financial advice on how to set up your portfolio. That's totally up to you, how you want to do it. I'm just showing you what I am doing. That does not mean you should copy me at all. I just want this to be an experiment to see how it performs compared to some other portfolios that are out there, such as Joseph Carlson, who constantly trades in and out of stocks. I am not going to do that. I'm just going to focus on these ETFs. So as you can see, my current amount of shares, I have 207 shares of JEPI, and my average share price is $54.01. This current payout rate for their dividend is 10.58% per year. And you can see that their expense ratio is 0.35%, so it's kind of high compared to SCHD or VU, but it's still relatively cheap compared to some other actively managed ETFs like ARK, especially since they are constantly selling covered calls and providing income for you in the form of a 10% dividend payout rate. So I am looking forward to seeing my dividend income from this holding. It should be about $100 per month, which is going to be really helpful in adding back to my SCHD holding. So it's also going to increase my earned dividends and my overall performance of this portfolio. I am not going to add anything else to JEPI though. Currently, I just plan on increasing my SCHD until it matches that target rate of 80% to 20%. So that's going to be my plan for this portfolio. So I'm going to give you a short overview of what JEPI is and how it works. So the basic overview on the JP Morgan website is that it's a conservative approach to equities that pays dividends. The Equity Income Fund, which focuses on high-quality U.S. companies with healthy and sustainable dividends, seeks to provide lower volatility access to stock market growth. So it's going to have experienced co-portfolio management team of over 25 years of industry experience, and it invests in high-quality U.S. companies that have attractive valuations and healthy dividends. So basically, JEPI has 86 holdings currently, and their funds and their assets under management is about $43 billion. Their turnover ratio is about 15%, so how much they're trading in and out of stocks. Their average market cap is 161 billion, and their current 1-year PE ratio is 12, and their trailing 1-year PE ratio is 15. So the companies that they're investing in aren't very expensive. They're relatively cheap compared to the overall market. It's about 17 PE ratio. Currently, their top 10 holdings are ConocoPhillips, United Health Group, Bristol Myers Squibb, Exxon, Raytheon, Johnson & Johnson, Bank of America, CVS, EOG, and General Dynamics. That's the top 23% of their portfolio is in the top 10 that I've just described. Their sector breakdown, they're in consumer services, consumer discretionary, consumer staples, energy, financials, healthcare, industrials, information technology, materials, real estate, short-term investments, and utilities. So they're really diversified in their sectors. If we take a look at their dividend schedule, their dividends are paid monthly, and they are about a 10% return annually, a little bit over 10%. And basically, if we look at the quarter in review, on their website, the JP Morgan Equity Income Fund outperformed the benchmark, the Russell 1000 Value Index, for the quarter ended September 30th, 2022. And looking ahead, their financials, they're saying that their financials exposure provides them with a diversification underneath the hood. We have taken profits from stronger performers like insurance brokers and underwriters. And on the flip side, banks are pricing in significant credit deterioration and receiving less recognition for their enhanced quality and earnings power. We feel we are being compensated for the risks given attractive valuations, but we are ensuring that we are focusing on companies with stronger consumer deposit franchises and best-in-breed management teams. Healthcare, we appreciate the resiliency and defensive characteristics of the sector, especially considering still undemanding valuations. In pharmaceuticals, we added to high-quality companies with strong free cash flow generation and underappreciated pipelines. Consumer, we continue to find opportunities and invest in companies with savvy management teams that can navigate a tricky backdrop. We are mindful that persistent inflation is bound to weaken the consumer, so we are leaning into companies that can keep consumers within their brand despite changing spending patterns and those that have strong pricing power. With cyclicals, energy has been the strongest performing sector this year, and while we continue to see upside given tight supply-demand dynamics, we've trimmed winners and shifted into companies that have more diversification and have also lagged. Alternatively, we have added to high-quality companies within the materials space, which we have seen pain from soaring commodity prices. Inflation has likely peaked, and we feel that companies with stable businesses, pricing power, and clear competitive advantages to secular growth like clean energy will be well positioned. So as you can see with this portfolio, JP Morgan is trading in and out of the market based on their beliefs of whether or not the future will be profitable for certain sectors, and trimming the winners so that certain companies do not become overvalued in their portfolio. And basically it's doing all the work for you. You don't have to sit there and worry about which stock is undervalued or overvalued. They do that for you. Basically you just buy in and let them do the work. I really think that's a major upside with ETFs that a lot of YouTubers don't cover. SCHD is another example of that. They take out the losers from the portfolio and continue to add new companies that will be winners in the future, or at least that they believe will be winners. Nobody can predict the future, but I believe that ETFs will highly outperform some of these stock pickers in down markets, just because of the broad diversification, as well as the switching out the winners and losers. So I will continue to track my performance with JP Morgan Equity Income ETF, or JEPI, and I will continue to update you on how I use the dividends from this holding. And yeah, I look forward to the future of this portfolio and seeing how it performs against the S&P 500 as well as other YouTubers who are trading in and out of the market. So yeah, this has been an update to my portfolio. Let me know what you guys think about the changes in the comment section down below, and I'll see you next time.